Good afternoon, ladies and gentlemen. My name is Kelsey Berry, Vice President of Marketing here at Ty J. Young Inc. Wealth Management, and welcome to today's live online event. Crash or no crash? Is it coming or is it not? We're so glad you're here, and I know right now all you see is a screen with our logo on it. In just a minute, Ty Young will be live. I have the privilege to introduce your speaker for today, and before I do, I want to share a little about our firm. We are different. Our firm is nationwide, serving clients in all 50 states. And perhaps what we're most proud of is our award winning customer service. We believe customer service is the most important thing when handling people's money, and most people agree. Now, a little about your speaker for today. Ty J. Young is the founder and CEO of Ty J. Young Inc. He is an expert in the field of finance and economics. He has been featured in many major media outlets, including CNN, MSNBC, Bloomberg, Dow Jones Newswire, and the New York Times. Ty is a frequent contributor on Fox News and Fox Business, discussing geopolitical events that affect your money. His mission in life and the foundation of our firm is to make a positive difference in people's lives. Ladies and gentlemen, it is my honor to introduce to you Mr. Ty J. Young.
All right, thank you, Kelsey, for that kind introduction. I want to welcome everybody to today's live online event. Crash or no crash? Is it coming or is it not coming? And I want to welcome everybody here. We have many clients on the live online event today. Many people who are not clients yet, all over this great country of ours. And a quick shout out to the Ladies Investors Club in Sarasota, Florida, watching as a group. Hope you all enjoy yourselves and hope you get a lot out of this today. And thank you for being here. Thank you everyone for being here today. Now, as promised, today you will learn what the economic indicators are predicting. What are the economic indicators and what are they saying about the market? And what are they saying about the economy? You'll learn what top economists are saying about the economy and ultimately about the market. And then, and this is important, very, very important. What does it mean to you? What we'll do is we'll frame, once we get through what's the economy going to do, what's the stock market going to do, we're going to frame what that means to you personally. Kind of give you the opportunity to look through the glass, you put glasses on so you have clarity on what's in front of you. It'll kind of put glasses on you so you have clarity on what's in front of you in your individual situation. So last thing, we're going to give you tools specifically to allow you to benefit by what the market's doing. So the market's going up or market's going down, you can benefit from those tools. And understand, investments are individual things. All right, it's not the herd mentality necessarily. It's what's right for you individually. We'll come back to that. But today we're going to start with crash or no crash. Is it coming or is it not? Now, I took economics in high school. And when the professor asked me if I knew the difference between a market correction and a recession, I said, I nodded my head, yes. Did I really know? No, I didn't. I learned that later on. All right, so what I'd like to do, and I'm going to try and keep this simple. It's been said that somebody that has a grasp of a concept can make it simple. All right, so what I'm going to try to do today is make this very, very simple and easy to understand. Now, there's people on this call that are very sophisticated, or on this event, that are very sophisticated investors. And they tell me they want to keep it simple. So across the board, we're going to do our best to keep it simple today. So I'm going to give you a couple of terms, 3 or 4 terms or 5 terms that I want to kind of give the kind of definitions of what we're talking about today. First, GDP, gross domestic product. When I say GDP, what that is, it's the total value of goods and services in our country in 1 year. So GDP is what every company in our country produces in services that they provide. That's what GDP is. Next thing, recession. We're going to talk about, is a recession coming? What is a recession? Here's the definition of a recession. If there are 2 consecutive quarters of GDP going down, meaning all the goods and services provided in the country, if that goes down 2 quarters in a row, the definition is a recession. The economy is contracting, it's getting smaller, it's producing less. All right, depression. A depression is a long, painful, agonizing recession. We had that obviously in the started in 1929 throughout the 30s. All right, market correction. The definition of a market correction is the stock market goes down 10%. We were very close to that last week. Market was down like 800 points one day, down other days as well. So we were very, very close to that, but we were up 500 yesterday. Market's about level today. We're not in correction territory right now, but are we going to get a correction, or are we going to get a crash? A crash is widely, and they don't, when you start looking at the Webster's dictionary definition or Investopedia or other places, they don't really put a number on a crash, but it's 30, 40, 50% is a crash. In 29, it was dramatically worse than that. So that's a crash, a substantial movement down to the stock market. You look at your 401k and you're like, holy smokes, that's down big. I don't know if I can retire at this point. That's a crash, right? So just want to quickly give you those definitions so it just remains simple throughout the live online event today. All right, so are we going to have a recession? All right, are we going to have a recession? Are we going to have 2 quarters in a row? Now, keep in mind, we've had 17 quarters of GDP going up, 17 in a row, all right, of GDP increasing. So now some economists, many economists, most economists are saying we're going to have a recession. Now, and here's what they say in their academic world. They say it like this. A recession is good because it weeds out the weaker companies and so forth. Well, it's a recession. If you lose your job because unemployment goes up, a recession isn't good for you. It doesn't feel good. It's painful. So, I mean, a recession is kind of like riding your bicycle up a hill, a long, painful hill. It hurts, right? It's painful. There's burning in your legs. It's very unpleasant. But at the top, when you get done with it, later on, you're stronger. That's what the economists are saying. They're saying that once we're through it, we've weeded out some of the weakness in the economy, and the economy can then do better. Doesn't sound like a lot of fun, but a lot of economists are calling for it. And here's why. First, the labor market is overheating. What's that mean? Well, full employment is 4.5%. Unemployment is full employment. We're below that right now. And what that means is employers are now having to pay more. They're having to overpay employees relative to that employee output. At your company, you might notice people being hired making a whole lot more than you were making when you were started. That's a result, possibly. That's a result of overemployment and companies having to pay more, all right? And it feels good to the employee when they come in, but what happens is later on, if you get the recession, they have to lay that person off, all right? So overemployment, core inflation's arrived. Things are getting more expensive. Housing, salaries, things are getting more and more expensive. Next one, and this is big, China. Many economists are calling for a recession because of the problems that we have in China. And when you do the math and when you do the research, just about everybody in our country doesn't like China. It's pretty interesting. And the situation with China, the trade issues, the holding of our debt issues, the problems with working with them issues, and I'll talk a little bit more about it in a second, but the problem is that's going to exacerbate inflation pressures, which will cause the Federal Reserve to raise interest rates, which will cause a recession. So talk more about that, but Democrats don't like China because the labor's too cheap. Republicans don't like China because of the theft of intellectual property. And when you ask the general public, they just plain don't like China. They know they're not doing the right thing by us. All right. Federal Reserve. Another reason economists believe we're going to have a recession. And by the way, I mentioned it a moment ago. Is a recession a stock market crash? No. Can you have a recession with the stock market going up? You can, yes. Can you have a stock market crash while the economy is doing great? Yes. All right. So they're related, but they're not joined at the hip. They can happen separately. And a stock market crash is often indicated by the economy. And that's why I'm talking about it today. Federal Reserve, 4 interest rate hikes, the prediction, 4 interest rate hikes in 2018 and 4 more interest rate hikes in 2019. That's the prediction by most economists. That's what they believe is going to happen. And they all believe that is bad as it applies to a recession coming. QE, you remember we printed trillions of dollars and just gave it to banks years ago. We did it from like 2008, 2014. Do you remember that? We printed trillions of dollars. We gave it to the banks and it was easy money. Anybody could borrow money if they wanted to. Well, when you have an action like that, sometimes when that action stops, you get an equal and opposite reaction, right? And so money is becoming much more difficult to borrow. Why? Because interest rates are going up and it affects you and it affects I on a personal level. It affects the companies that we do business with, which makes the goods and services more expensive for us. So that's an issue as well. The ability to borrow more and more difficult. Now, corporate debt. Corporate debt, and again, this is why, another reason why economists say we're going to have a recession. Corporate debt. Corporations, because money has been so cheap, interest rates have been so low, they can borrow all kinds of money at very, very low rates, just like you and I could on mortgages. They could borrow at very, very low rates. They've run up debt, many companies, 4 and 5 and 6 times more than they should, right? So as interest rates go up, they have to pay more and more interest and more payments of interest to their debt companies. All right. And so the earnings of those companies go down. Well, if the earnings of those companies goes down, what happens to the value of the stock? It could go down too. I'll come back to that. But that's important to recognize that. And as it becomes more and more difficult for them to pay those payments, their payments become a bigger and bigger portion of their earnings, their credit rating goes down. And as their credit rating goes down, they have to pay more interest to get loans. So here's an analogy. Let's say you have a mortgage and this month your mortgage payment is $1,000. And interest rates go up and next month it's $2,000. And the following month it's $4,000. And the following month it's $8,000. Tell me how long it would take before you're foreclosed on. How long? Well, at some point, it's impossible to pay because the interest rates go up, the credit rating goes down, it gets more expensive, it's harder, and you can't pay. That is negative. That is negative for the market. All that being said, because of those economic indicators, one particular economic firm called Guggenheim, they are calling for a 45% correction in the stock market sometime in 2019 and 2020. Now, there is another camp of economists that are saying that the stock market isn't necessarily going to crash. It's just going to continue for years to come. Who's right? Who's right? Let me kind of tell you what the economists that are calling for a market crash are saying. They're looking directly at the Dow's down 3 straight weeks in a row. All right. It had been down up until yesterday, I think 6 straight days. Last Thursday, the market was down like 800 points, third biggest drop in history. Treasury rates are going up 3.25%. And the Fed, as I just pointed out, is continuing to raise interest rates. So the trend of the market is down. This is what the economists that think the market's going down is going to crash. This is what they're saying. The trend is down. We're getting wild swings up and down, up 500 one day, down 800 the next, or reverse of that. A lot of volatility. Now, we are in the longest bull market, the longest up market in the history of our stock market. We've never had one this long. We're now it's like 30 days maybe beyond the longest one ever. It is a record. And at the end of a bull market, especially as interest rates go up, you get volatility. The market goes up and the market goes down. The market goes up and the market goes down. We're seeing that, and the economists are pointing that and saying, yep, here comes the crash. That's what they're saying. All right. So, and some of the leading economists are saying that. All right. Inflation is on the rise. All right. I talked about it a moment ago. Trade wars with China. The threat of a trade war with China. Analysts have been calling for a correction, some of them for 4 or 5 years now. And then we have hurricanes hitting the East Coast, hitting on the Gulf Coast, and our thoughts and prayers go out to those folks that are dealing with those terrible issues. personally, they're personal tragedies, and there's economic tragedies as well, which, whether you live in those zones or not, will affect your money. So the economists that are calling for a crash, they say the trend is down and the trend's going to continue. They say interest rates are up, that's going to push the trend down. They're saying inflation's going up, so there's nothing really to save it. They think there's going to be a crash, and they're calling for it in the next 18 months or so. All right, that's what they're saying. Now, there's also economists that are saying the stock market is going to continue to do very well going forward. And frankly, I like the ones that are saying it's going to continue up better. You know why? Because when the stock market goes up, people make money in their 401ks. Our clients make money. Their gains lock in. It's a wonderful situation as the stock market and the economy is doing good. So the economists that are saying that we're not going to have a crash, here's what they're saying. All right, they are saying that the economy is booming. They're booming. 4% GDP growth this last month, and for the last quarter, the third quarter. The tax policy, President Trump and Congress passed a tax policy that greatly reduces the amount of tax that Americans pay, especially people under about $100,000. It's in income. It's dramatic how much taxes that they save. I mean, it really made a huge impact. And I know that from reading the news, and I know it from personally interacting with many, many people. It's making a dramatic, that is powerful, and that's driving the market because people have more disposable income. They can invest it, they can spend it, which all drives the market up. All right. Regulatory relief. I think to date, for every one regulation that this administration, the Trump administration, put in, they're removing 22 regulations. And most of those are worthless, antiquated regulations. They're putting in good regulations. And I say that they're getting rid of bad ones and getting in good ones because the market, it's all about the numbers to me. The market is responding very, very positively. The market is up dramatically, since this administration was elected and came in. All right. The trade wars, what we're having, that's actually putting pressure on other countries to do business with us. It actually has a positive effect. And the USMCA that replaced NAFTA is a great example of how getting rid of, or having, this administration putting pressure on these other countries to come to the table with us and getting a better favorable deal. Some people like that, some people don't, but you can't argue that your 401k is not bigger, because it is if you have one, right? So the people that are calling for the market to continue are saying taxes are down, regulations down, trade's going up. There's probably going to be a Chinese-US summit in November. The dollar, because interest rates are going up, the dollar's getting stronger. Dollar gets stronger. I mean, it's better for imports. It's better for travel around the world. So there's two camps. There's a camp that's saying that there's going to be a market crash, and there's a camp that's saying that there's not going to be a market crash. So what is it? Which is the answer? Well, the most important answer is the answer to you. Is it going to crash? Here's the reality. We have recessions. Our economy does well, and then we have a recession. How often does the recessions happen? It happens about every 8 to 10 years. All right. When's the last time we had one? About 8 to 10 years ago. All right. Stock markets crash. The stock market historically does very well, and then it corrects, and then it crashes. How often does that happen? About every 8 to 10 years. When's the last time it happened? About 8 to 10 years ago. All right. Is the market going to crash? Absolutely, yes. History repeats itself. That's going to happen. The question is, when is it going to happen? When is it going to happen? Is it going to happen in the short term? Is it going to happen in the long term? With the economy working like it is, it's very difficult to say. Guggenheim says the market will be down 45% or more sometime in 2019, 2020. In the meantime, it could continue to go zooming up. It could go up 30% between now and then before it goes down. So what do you do? What do you do? How do you take advantage of that? What are the things that you can do given that information? That information I just gave you is widely available, and it's public knowledge. How do you use it to your advantage? Information and knowledge is power. So the first thing you got to do is take a look at the most important person in this equation, you. How do you feel about money? How do you want your money invested? How do you feel about security? How do you get a feeling of security when it comes to your money? What investment or how much safety do you need so you feel secure? I mean, the market's going to go up, the market's going to go down, it's going to grow great for a while, and it's going to crash. We all know that. All right. So let's talk about you just a second. We're investing in a crazy world, so knowing yourself is very, very important. Matter of fact, the best financial advice that you'll ever receive, where does it come from? Ladies and gentlemen, the very best advice you'll ever receive, financial advice you'll ever receive, comes from you. It comes from you, all right? There's a survey done, and every year the survey's done. About 50 questions on the survey. This survey is done for people over the age of 55, within 5 years of retirement, just retired, or retire within the last 5 years. Pardon me. Now, 50 questions on the survey. The two most important are the following. And I'm going to give you the question. I'd love you to write your answer down. I think that'd be great. That way, you have your answers, because the number one answer, what the survey said, that's one thing. How you feel is something completely different, potentially. So here's the first question. I'd like you to write your answer down. What is your number one fear financially? All right, your number one fear financially. Write it down if you would. All right, here's the number one answer. Number one fear financially, running out of money. Number one answer, running out of money. Next question, what's the number one thing your money provides for you? Write your answer down if you would. Number one answer, security. All right, question for you. If your number one fear financially is running out of money, and the number one thing your money provides for you is security, should you really have all your money at risk in the stock market that we know is either going to go up or it's either going to go down? It could crash in the future. History says it's gonna. The history says we're going to have a recession. The answer is, when are we going to have it? That I don't know. All right, nobody does. I don't have a crystal ball to tell you that. But here's the reality of the situation. Stock markets go up and stock market goes down. Economies grow and economies have recessions. All right, what's most important is you and what you want and what you need when it comes to your money. All right. The GDP is rocking right now. Whether the GDP is rocking or we're in the middle of a recession, human beings, you and I, have a basic need for security. I mean, God wired us that way. We have a basic need for security. All right. And in this society, money is a huge part of that security. All right. So if we know that markets go up and markets go down, and our money's in the market where we can lose it if the market goes down big, hopefully it doesn't, hopefully it continues up. But if it does, we could lose it. How do we position ourselves for success? Because that seems like a lot of risk to me. All right. I can tell you, many financial experts, many economists, many financial advisors agree that if you're within 5 years of retirement or less, or retired, or about to retire, or in retirement, you should have no less than 50% of your retirement money completely protected against losses. Completely protected against losses. That's not in low risk. That's completely protected against stock market losses. Stuart Varney famously said, one morning when we're having a crash or having a big down day, he said, if you're anywhere close to retirement, you should have at least half of your money off the table in a safe place. Well, what's a safe place? FDIC insurance, treasury bonds, and guaranteed insurance contracts. That's it. Those are the only, in my view, safe places for your money. Now, some people foolishly will listen to their advisor or listen to somebody that says to them, when the market starts going down, we'll just get out then. That's kind of like saying, I'm going to wait to put my seatbelt on until after the accident starts, right? Once the accident starts, once the market crash starts, it's too late. You might not be quick enough to get out, or you might not be emotionally able to, because then it goes down 10%. You go, well, I'll wait for it to come back. It goes down 20%. I'll wait for it to come back. I can tell you, there's a whole list that you might even relate to that. In 2008, they just kept saying, wait for it to come back. Next thing you know, they're down 50% on their money. Now, has it come back? Yeah, it has. It took 10 years. Do you have 10 years? Or 8 years, took a long time. Do you have 8 years to wait? If you're within 5 years of retirement and you need your money to retire, do you have 8 years to wait till you get it back? See, that's the thing. It's you. The markets are going to go up. Historically, the stock market average is about 10%. 10%. If we look back to the beginning, the stock market is over 102 or 5 years or whatever it is now, or the S&P 500 back in the 1950s, it's going to average about 10. But some years you could lose 50%. Now, I hope we never deal with that. I don't want to deal with that. I don't want that for anybody. I want growth. I want prosperity, and I want the American dream for everybody. I want it for you. But you have to take, and you have to take an active part in your own rescue. You've got to put yourself in a position to win. So what is a position to win? How do you get yourself in a position to win? Well, you got to save enough to begin with, right? And going into retirement, you reduce debt, you consolidate debt, you review your portfolio, you figure out if you're paying too much in fees. I mean, it comes down to this. I mean, here are the four elements. You reduce risk, you reduce fees, you increase growth, and if you can get a bonus along the way, heck, why not get a bonus along the way? It can be done. It can be done. It's just a matter of doing it. Everybody on this call knows how to do it, or on this live online event, you know how to do it. And if you don't know how to do it and you need help, no problem. Call your Ty J. Young Inc. advisor, and they will help you, he or she will help you navigate from getting your money in a place where it's at risk to a place where it's protected. And you can still average historically about 6 to 8% average, but never suffer losses. I mean, it's been a long time since we had the 2008 crash. And it really was suffering back then, but now it kind of feels good. We're going up every day. I mean, we didn't last week, we went down 800, but it kind of feels like we're going up and up and up and up and up and up and up. We're at the longest bull market in the history of our country. We're in it right now. The market is volatile, interest rates are going up, and the bulk of economists are calling for a recession. Now, we all know that a recession and a stock market crash are not the same thing, right? But we do know that the market crashes from time to time, and our money potentially is in the market, and it doesn't have to be. You can have your money, and we'll tell you more about this when you call us. You can have your money in a place where it's protected against market losses. You go up with the stock market, your gains lock in, and when the stock market goes down, you don't lose anything. You do receive compound interest, and there are no fees. Now, if you're a client, you already know that. You love your annuity. It's called an index annuity. You love it. If you're not a client yet, you might be saying to yourself, I don't want an annuity. All right. So here's the thing. And this is kind of a funny one. And people say, I don't want an annuity. I want my money safe. I don't want to pay any fees, right? I want to go up with the stock market. I want to lock in my gains every year. I want to earn compound interest, historically about 6 to 8%, but I don't want an annuity. And here's what I say, ma'am or sir, if you really want those things, I'm going to have to ask you to put aside or to get over the word annuity, because that's the only way I can give it to you, or we can give it to you. You see, again, are we going to have a crash? We are. The question is when. And then the other question is, are you going to be just about to retire, or just in retirement to begin with, and suffer substantial losses if God forbid when it comes, or are you going to be in a protected place where you benefit from stock market gains? Because I think the market does well over a long period of time, but not hurt when the stock market goes down, because I have to face the reality. I do, you do, we all do, that sometimes the stock market crashes. Don't have yourself in harm's way. Ladies and gentlemen, it has been an honor and a privilege to have you on this live online event today. I hope this information has helped you. If you have questions, send them in via email. Talk to your Ty J. Young Inc. advisor. Happy to answer those questions for you. And if you would like us to, we'll assist you in getting yourself in a position where you can participate in stock market gains, but not participate in stock market losses. You can make historically compound per year about 6 to 8%, and you can do that without paying fees. And that can be done for your IRA. It can be done for your money in the bank. It can be done for a 401k rollover. You can have it all. So, for a lot of people, having it all is having it safe and getting a reasonable rate of return. You can have both, but you have to take action. And that action is call your Ty J. Young Inc. advisor, send us an email, say I need some help, and we will help you. All right, and it'd be an honor and a privilege to do so. Ladies and gentlemen, again, thanks for being here today. Hope you enjoyed, hope you got something out of it, and send your questions in. We'll be happy to answer them for you. All right, have a great day.